Dhiraj Sachdev from Roha Asset Managers as well to join in on the show. Dhiraj, hi, afternoon. While we're talking about China, and that's had a staggering rally, India has been no less. Not a 6% move, but a comfortable move above the 10,700 mark. What's looking interesting to you to even buy right now? Would you say tread with caution, profit take here?
Hi, Aisha. Thanks for having me. So we are living in an equity market world where reactions are typically sharp, swift, and short-lived. Thanks to algo trading and leverage positions that create ferocious and high-speed extreme sell-off and then subsequent rallies. The sharp fall leads to panic formation, leaving scope for bargain buying. This is exactly what has happened over the last few months. So not surprised by this untimely rally. After all, in the history of pandemics, equity markets tend to decline sharply and then recover. Now, there has been unprecedented and proactive reaction from global central bankers in providing huge stimulus, and coupled with low interest rate, has created global and emerging markets to rally. So while it may be reasonable to see some sell-off or consolidation post this last 3 months of rally, we expect declines or corrections to be short-lived, given that incrementally factories and shops are opening up amidst acceptance of COVID. So many high-frequency data such as e-way bills, power consumption, online payments, freight carried by trains, and Google mobility trends do indicate month-on-month improvement, and activity levels are actually currently at 80 to 85% of normal levels. While few states have reverted back to stricter lockdowns in containment zones in July, and so recovery pace may be slower, we do expect demand recovery in India should be swift post an inevitable end to the lockdown. Nevertheless, normalization of economy is important at the earliest, given stress in SME, MSME corporate with potential job losses and higher working capital requirement. Now, from a valuation perspective, many companies are still undervalued with respect to their long-term potential and are mean reverting. In small caps specifically, we find a number of companies available at even 4 to 5 times their sustainable operating cash flows, even though their near-term earnings will be muted. So value stocks and small caps have potential for alpha or higher than market average returns. So there is no existential threat and business is cash flow generating. Markets will continue to reward these companies in general. So my view is that trying to time the market bottom or rallies is a futile exercise, as the markets will look beyond short-term demand issues. After all, value of many a business is far higher based on discounted cash flows it can generate over its life, compared to irrational quoted price driven by pessimism or fear. So given that market precedes economic bottom, there will always be disconnect between market rallies and ground level reality. So we, from a very specific investment broad sector point of view, we like several businesses, which includes consumer companies and mid and small caps like food processing, footwear to digital media and personal care. We also like agriculture-related themes that produce farm equipment like tractors, including seeds and crop protection companies. Their earnings impact has been limited during lockdown. And we expect rural demand could remain strong since the rural economy has been positively affected by bumper rabi crop, bright prospects of Kharif. The MSP hike, which has been taken almost 12% in 2019 alone, a milder shutdown and quick supply normalization for agro produce, along with stimulus measures. So government data also indicates large expansion of Manrega scheme, which is good for rural demand.
That's nice. Within what is actually holding up the market right now, Dhiraj, and due contribution to, yes, Reliance for sure, but the other one being the private banking names. While we've seen a slew of fundraisers coming in, there's also extremely good takeaways coming in from the Q1 update from HDFC Bank. And I guess that explains the move in the stock price as well today, or for that matter, the recovery that one has seen play out from the March lows. Within private banks, where do you still find comfort even after the recovery that has played out in the last month and a half?
So financials do offer highest margin of safety post sharp correction, provided there is access to capital and quality of book is fairly secure. As normalcy in business comes back, we expect collection efficiency to improve gradually. At this stage, we would rather prefer secured lending companies at near or lower than their book values. Within NBFC, it will be like housing finance with low exposure to builder loan or gold finance companies. Microfinance companies being unsecured are at risk, but given that their target market is rural lending or agriculture that are in essential category, selective opportunities do exist. Overall, the financial services may go through a volatile phase in the short term, no doubt, including banks. But its ability to create value in the long term is fully intact. I mean, challenges do exist in the near term related to moratorium, asset quality, and growth. But both private and PSU banks will have to deal with the rise in NPAs post-moratorium period. I mean, the estimate is that anywhere between 5 to 20% of the loans under moratorium could turn out to be fresh NPAs. So one-time restructuring of such loans may be required from RBI to give more time to repay. But broadly, private banks are better placed than PSU banks in general.
Okay, that's the view coming in. Just want to check in on the rest of the market and holding out quite smartly, you'd have to say. Even the broader universe is neck to neck with the frontliners. In fact, you've got a pretty stellar rally that's playing out for the mid and the small caps this afternoon. Take a look at individual constituents in trade, the likes of Bharat Dynamics, HAL, Prism Cement, Brigade Enterprises, Aegis Logistics, etc. Let's get in a chart check going then on some of these names as well. And Kunal, wanted to get in your take on how you're looking at yet again some of these names within the PSU sphere. Some of those defense stocks are in focus. The Maharashtra Chief Minister talking about the potential opening of some of the hotels with very strict SOPs in place. Would you bet on any of the names within this space, or do you think that it's a long road to recovery and that as of now it would be a bit premature to take a call here? I'm talking about the entire basket of tourism as well as hospitality companies.
Is a question for me?
Dhiraj, that was for you.
Yeah,
the
okay.
hotel stocks, tourism.
Yeah, I think there is still a long way to go. We believe even if the lockdown is lifted, I think people will voluntarily not travel. And so travel and tourism will be at the last phase of the cycle where it could recover. So we would rather avoid it. Plus the business is capital intensive. They have fixed costs which are very high. The operating leverage will play out negatively. So right now we are avoiding any hospitality, QSR or hotel related stocks or tourism related stocks for now, including multiplexes.
That's the word coming in on how some of these hotel stocks could be looked at. Look at M&M, look at BHEL, both these names. BHEL is now surging a solid 5.5%. Dhiraj, in fact, PSU stocks is the other theme in the market. While we all know that disinvestment is going to be delayed, the market is surely revisiting some of these names, be it a BHEL, be it a BPCL, a Concor, BEL, etc. Do you think there is a contra opportunity here?
Yeah, definitely. In many cases, in PSU stocks offer sustained dividend yield as well. One can't categorize all PSU businesses into one basket. One has to be selective enough because each business can be very, very different. But nevertheless, one common thread that runs into PSU is that their valuations are attractive relative to the earnings or the cash flows that they generate. Many of them are in the monopolized category of defense or railways business as well. And I think the size of the market opportunity in many of the cases is fairly high for them to sustain the growth momentum. So we believe that the undervaluation, dividend payouts, etc., makes it some kind of a contra theme. Of course, one has to be selective on respective businesses within PSU basket.